What, from your perspective, have you been thinking about in terms of like the perspective of a buyer? Like, what would you do? And I'm only thinking this because we've got some projects here that we're starting a pretty dramatic project at Gray Capital
Yeah.
that I want to mention here and just shoehorn because that's part of the reason why we've been so busy is because we're beginning a project that actually factors this in here and takes a proactive kind of step in anticipating what the market's going to look like.
Yeah, so Gray Capital, we did just launch this week the Gray Capital's Midwest Multifamily Fund. It's an institutional fund, so it has a high minimum. It's not necessarily designed for retail investors, although individuals can participate, but it's got $1 million minimum, obviously only open to accredited investors. But so much of the thesis is that the fundamentals for multifamily over the next decade are incredibly well anchored. They're very strong, especially in
Yep.
the Midwest. And there's a potential for some dislocation over the next year or two in the multifamily market that could present some incredible buying opportunities. Even if that distress never ends up coming to be, the fundamentals are really clear that buying multifamily assets over the next couple of years, really starting in 2026, is going to be a good time to be buying.
Yeah.
Hopefully in 2025 also. It's just there's almost no volume right now. So
Yeah.
we are essentially building a war chest with wealth managers, family offices, and institutions where we're going to go out and buy 7 to 10 properties in Indiana, Ohio, Michigan, kind of our core Midwestern markets. Basically, throughout 2026 and 2027, build an incredible portfolio at a low basis, high quality properties, core plus, value add.
Yeah.
We've been building out our management and ops teams. We've got this awesome proprietary tech stack that we're able to just operate more efficiently, a little quicker, do things cheaper. Really proud. It's been an incredible amount of work from the Gray Residential and Gray Capital teams over the last couple of years. And everything is coinciding of where our operations teams, like we're really hitting a stride.
Yeah.
And like we've got kind of the disruptions and the changes over the last couple of years more or less dialed in, always improving, always tweaking, always
Yeah.
iterating. But we're seeing like the market clear out from buyers a little bit, creating an opportunity. And, we're seeing very few attractive opportunities today, but we see the path to opportunities coming unlocked again, end of this year, end of 2025.
Yeah.
Really getting into 2026 is going to be a great opportunity to be in the market as a buyer.
Yeah.
And, Great Capital, we're uniquely positioned of where, we didn't take out a lot of floating rate bridge loans over this last cycle. We locked in a lot of fixed rate debt. So, we don't have deals that are in distress. We've never had to issue a capital call.
No capital calls. Okay.
Yeah,
I was
yeah.
going to ask you that.
So, yeah, we just because it's our strategy is always part of just how I was raised, but we've always had the assumption that, well, interest rates could go up.
Yeah.
If it can, it might. And so we should underwrite for that contingency. And I want to maximize the chance of success because I don't want to lose anybody money. I just
Yeah.
want to have a successful deal. And so even sometimes like the whole popular thing in the narrative back in 2021 was, you're so old school and, very unsophisticated for using fixed rate debt because you're locking yourself in. You don't have this
Yeah.
flexibility of a low prepayment penalty. Like you're going to be locked in. You're leaving money on the table. Bad decision. I don't know how many people told me that
Yeah.
back then. And we're like, well, we're gonna lock this rate. I mean, it seems pretty good. We're locking a 3% interest rate, and they're like, oh man, but we're getting a 2.8 and it's floating, but like we've got a couple more years of interest only, and we can trade out of it in 2 years, and we're gonna make a
Yeah.
3x. Well, all those people have basically lost. A lot of those people have lost all that equity. That
Yeah.
money's gone, or it even hasn't been realized. The reality is, on paper, at very least, the equity's gone.
Yeah.
Our deals, not necessarily the case, even if you do price adjustments and value adjustments based on cap rates expanding a little bit. So we've got a good track record. We built a lot of credibility with our partners and investors. And while we held off on launching our second fund for a while, we've launched funds in the past because there wasn't enough deals in inventory. So
Yeah.
we're taking rifle shots, one deal over here, one deal over here, and we're going to continue to do that until we raise $150 million for this fund. So, if you're a retail investor, we're still going to have deals with a lower $100,000 minimum, just like you've always known from Gray Capital. But for institutions, we're going to have this larger pooled vehicle one of the reasons to come into the fund versus the direct deals, well, a lot of wealth managers don't have the capacity to underwrite individual deals. They need a strategy. And they have a lot of clients who want to get into alts, want to get into multifamily,
Yeah.
but like it's hard to kind of navigate, and they want kind of the blessing from an advisor. And so the advisor checks Gray Capital out, make sure we're the real deal, we've got track record, all the rest, the strategy makes sense. We've got an advisory board making sure we're aligned, doing the same things, and then we go out one subscription document that their client has to sign. Get them into 7 to 10 properties over the next couple of years, as opposed to doing a bunch of deals. And to incentivize, we're trying to be at the leading edge of the market, and where a lot of funds or real estate syndications have like a 70-30 LP-GP split. We have in the past as well. We're actually cutting that in half. So we're cutting our profits in half, giving those all to the LPs. And so we're using an 85-15 split, which is even more advantageous than kind of your standard what you'd see in like the hedge fund world of an 80-20 split. Your standard like 20 and 2, your 20% carry and a 2% asset management fee. We're turning that into a 15 and a quarter. So 15% carry and as low as a 25 basis point asset management fee. It scales down. It starts at 1%. So that's the highest fee you'll pay if you're coming in for the minimum of $1 million. Larger allocations, can scale you down to only 25 basis points.
Yeah.
We can do that because we use a lot of technology. We're not bloated. We've been around for 10 years, but we haven't been around for, 50 years building up all this just, baggage that we have to carry around. So move a little quicker. I think maybe a little bit smarter. That's how we've done it in the past. And we launched the fund this week. So how we're looking at it is we'd love for that inflection point to accelerate a little bit. So we can see some opportunities. But we can't time everything. So that's why, look, we want to be building the war chest right now, look for like-minded partners to consolidate on this strategy. And then as deals emerge, as they will, we can do this, the volume right now just in today's market. But we think there's going to be more opportunities next year in 2027.
And I think that that has kind of resulted on the stuff that we talk about as a result of the research that we've done, the things that we talk about.
It's all
today.
It's all data driven. It's not let's go raise some money so we can get some fees. It's that we're literally digging into the market, and we do this every week for not just for fun and for marketing, but because it drives the decisions of our business. We release these reports, we share information, we have internal memos, and it drives. It's that data driven approach that allows for an investment thesis to materialize.
Well, and there are so many times where it's like, well, should we talk, where it could have been like, oh, should we talk about, maybe the market's looking for a bottom right now when we're trying to sell an apartment to investors. Well, actually, no, what we're working on right now is very much following this, our perspective that we are very open in sharing on the Gray Report. So,
we didn't do a deal earlier this year for a variety of reasons. The lender was being difficult, and, we found some things in due diligence. We made a decision not to continue. We lost some money because we had money on the line. We're already spending money. But we're also looking at the data and adding on to just the factors of maybe not right now is not the right time. And actually we see a higher chance of some cap rate expansion in the near term. In the end of 2025 or this year might be a better time to start picking up deals instead of right now. That being said, we see interesting deals that pop up here and there. It just oftentimes they end up getting competitive, and we are in the Midwest. That is, you can underwrite positive rent growth because if you're trying to buy something in the Sun Belt right now, you can't put positive rent growth year one.
And cap rates. That's something that this is I'm working with our new analyst intern, math genius, and something that we really haven't hit on a whole lot when we're talking about the strength of the Midwest versus the Sun Belt and other gateway markets is that their cap rates are much lower versus Midwest anyway. So Midwest is performing better, and it's got a better cap rate. It's got a higher cap rate. So inherently, you're going to be making a little bit more money if you're going straight by cap rate. But,
and again, coming back to just can you boil down the thesis? And part of a Gray Capital, it is take this idea of taking slightly higher cap rates,
Mm-hmm.
and with the conclusion that they are higher because of inefficient markets and
Yeah.
people just don't know about the Midwest,
People
so it's
are so
unknown.
excited about Phoenix, and they just fly right over.
Yeah, exactly. So that just lack of information leads to a higher perceived rate of
Yeah.
risk. So, okay, it's a little bit risky because who's living in those? We've said it in the past. Who lives there? What do they do?
Yeah, yeah.
And they think of Rust Belt. They
Yeah.
think of Detroit. They think of Cleveland, and they don't think of Columbus, Kansas City, Indianapolis,
Yeah.
and markets that are growing. And so it all gets lumped into one category. And so I used to call it, cap rate debt arbitrage.
Yeah.
Basically, we're taking the same debt, that the Federal Reserve is, pumping out, if we're going to New York City to get it, taking that same debt that you'd have the same rate on a deal in Phoenix or Atlanta or Indianapolis.
Yeah.
But I'm taking a deal that has similar rate of growth, but at a higher cap rate. And so it's just like geographic arbitrage, essentially. That it's why I love real estate in private markets is because it allows you to exploit the inefficiencies in the market versus a public market where, it's not a perfect market, but it's much more closer to a perfect market where, market knows as much as everybody and all of that can be priced in. And it's it's a discounting and forecasting mechanism where real estate is really kind of stuck in the past. And so if you can use some of those forward indicators and the forecasting mechanisms, then go in and make decisions on lagging markets and markets that we have proprietary knowledge of, that we have exclusive knowledge because we live here, we operate, we know the players. And so in real estate, insider trading is the name of the game. Like I can use information that I know to make decisions, and that is legal. And
Sometimes they have to be insider trading. You can't tell anyone.
Yeah, no, I'm not going to tell anybody. Why would I tell anybody? It's private. I'm not in a public company. I don't have no obligation to tell everybody. And so if I know everybody in the industry, if I know the developers, sitting down with a developer this morning, if I know what they're building already, what it costs them to build, what they're planning, what their thoughts are, it gives us a huge competitive advantage as opposed to someone that's in, sitting in New York City and looking at spreadsheets and CoStar and wherever else they're using to make their own. That's all they're using to make a decision.
Yeah, yeah.
So
it's true. And if you want to learn more, you could go to graycapitalllc.com/Midwest, and they'll have all that information about this upcoming
Yeah, we've
fund.
got a whole data room that's on our portal. Check it out. We have so much due diligence materials. We have research reports in there, white papers, market studies. I think it's pretty impressive. I don't know if the amount of stuff that's in there. I think it's a lot more than you typically see. We love doing this. We're passionate. We've been doing all this research. It's not like we decided to do this last week.
Oh no.
But again, reminder: if you're if you're a Gray Capital investor and you're like, I can't allocate $1 million to a fund, or you're like, I don't like funds, we've got you, because we're still going to have the same kind of direct syndication deals we've done in the past. They can be sidecars to fund deals. Also, we're probably going to have a deal before we do our first fund deal anyway. So I'd love to get a good deal if and only if we can find a good deal in 2025.
Yeah.
I'm not confident we're going to have more than one, though. We're probably going to have one, if any. So if you want to make an allocation with Great Capital this year, if you hear about it, don't wait, think we're going to get another one.
Yeah.